The Federal Reserve voted not to raise interest rates this month, but is this it for rate hikes, or are there more to come in the future? And a lack of housing inventory is still a major problem affecting the real estate market, but is that going to change? This is the Market Brew. Hi everyone, Mike Tilford here. This past Wednesday, Federal Reserve policymakers voted not to raise a key benchmark interest rate this month. However, Federal Chair Jerome Powell warned investors that future rate hikes were likely to occur if the economy doesn't continue to cool. This is a bit of a reprieve for buyers that are currently facing interest rates that are the highest they have seen since 2007. This is of course coming after a run of historically low interest rates since the beginning of 2020, and even going back as far as early 2008. Some economists believe that the efforts of the Federal Reserve as they currently stand will be sufficient to continue the downward trend of inflation. However, some at the Fed believe that there may be a need for 2 more rate hikes this year in order to bring inflation back under control. In a statement explaining their unanimous vote to keep the benchmark rate funds rate at the current target rate of 5.0 to 5.25%, members of the Federal Open Market Committee said they are strongly committed to returning inflation to its 2% objective. It may make sense for rates to move higher, but at a more moderate pace, Powell said. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting. Powell has left the door open for further rate hikes in the coming months, which isn't really a big surprise for those paying attention. The Fed has been extremely aggressive with rate hikes over the past year, and I feel like at this point they would increase rates for the chance of decreasing inflation rather than fail to increase rates if there was a chance that inflation could continue to rise. But only time will tell, and we should know in the next couple of months the effects of the current rate hikes. But this halt in rate hikes won't be enough to reverse the trend in the real estate market, at least in the short term. A whopping 91.8% of current homeowners are sitting on a mortgage with less than a 6% interest rate. In addition, 82.4% have a rate below 5%, 62% have a rate below 4%, and 23.5% have a rate below 3%. This is the biggest factor holding back the real estate market. According to Redfin Deputy Chief Economist Taylor Marr, high mortgage rates are a double whammy because they're discouraging both buyers and sellers, and they're discouraging sellers so much that even the buyers who are out there are having trouble finding a place to buy. He continues, the lock-in effect is unlikely to go away in the near future. Mortgage rates probably won't drop below 6% before the end of the year, and most homeowners wouldn't be motivated to sell unless rates dropped further. Some of them simply don't want to take on a 6% plus mortgage rate, and some can't afford to. Essentially, a vast majority of homeowners are only selling in this market if they absolutely have to. They have no motivation to give up their historically low interest rates for rates above 6%. These rates are not only discouraging to sellers, but for buyers as well. For buyers who can still afford a mortgage over 6%, many still can't find homes due to the lack of inventory, and buyers still outnumber sellers in the current environment. Compared to 2018, the U.S. currently has 39% fewer homes for sale. With the current state of things, it is bad news for any buyer sitting on the sideline waiting for home prices to come down drastically. With inventory as low as it is, the market is effectively crash-proof. In order for the housing market to crash, the supply of on-market homes must dramatically increase, or the effective demand for homes must dramatically decrease, or both. This is not going to happen without some sort of external catalyst. The reason for the housing crash in 2007 was due to a sudden influx of homes on the market, mostly bank-owned properties due to foreclosures. This sudden influx caused a swift shift in supply that dramatically outpaced demand, thus creating a sudden drop in value as owners undercut one another to offload homes of ever-decreasing value. This is not going to happen in the current market. The conditions of the housing market are completely different from 2007. So, good news for homeowners. Well, that's it for today. I'll see you next time, and as always, I'm never too busy for your referrals.